Let's talk about a company you've probably never heard of, but whose product you have almost certainly used. This is Taeyang Corporation, and they are, for all intents and purposes, the invisible king of a massive global market.
Okay, 60%. And no, that's not a typo. We're talking over 60% of the entire global market for portable butane gas canisters. Just let that sink in for a second. Every time you see one of those cans at a campsite, a Korean barbecue restaurant, or a backyard cookout, there's a better than even chance it came from their factory. That is an absolutely incredible level of dominance.
So that's the big question, right? How does one single company manage to achieve a near monopoly on a global scale? What is their secret sauce? And maybe more importantly, in today's world, is that kind of dominance really as secure as it looks?
To figure all that out, we're going to dive into some analysis from HDIN Research. They've really taken a close look under the hood of Taeyang's business, which is all built around their main brand, Sunfuel.
You know, you might think their power comes from some kind of secret, high-tech patent, but that's the myth. The reality is actually much more, straightforward. Taeyang's power really just comes down to two things: absolutely massive production scale and an ironclad, obsessive focus on safety.
And this is basically their whole playbook. They have the world's largest automated production lines, which just crushes costs. Their R&D spending? It's tiny, only 0.5% of revenue. Why? Because they're not trying to reinvent the wheel. They're just perfecting the manufacturing of it. And when your product is flammable, that zero-defect strategy isn't just a marketing slogan, it's everything. It's their single biggest competitive advantage.
Okay, now let's get into the financials, because this is where the story takes a really interesting twist. The 2025 numbers show us a fascinating paradox. Something just doesn't add up, and you really have to dig in to see what's actually going on with this company's health.
So, get a load of this. In 2025, Taeyang's revenue actually fell by almost 8%. Sales are down. But at the exact same time, their net profit skyrocketed by over 43%. Wait, what? How is that even possible? How can you make dramatically more money while selling less of your main product?
And this is the exact question any analyst worth their salt is going to ask. If the core business is slowing down, where on earth did this huge jump in profit come from? The answer tells you everything about the quality of their earnings.
And here it is. This is the big aha moment. That $8.34 million profit, it's not what it seems. A whopping $7.38 million of it, that's pretty much all of it, came from a one-time gain from winning a shareholder lawsuit. Their actual profit from, making and selling stuff, less than $1 million.
This is what's called a non-recurring gain. It's a classic one-off event that's not going to happen again next year. It has absolutely nothing to do with the fundamental health of the business. It's basically a financial sugar high, and it's masking a much weaker performance underneath.
So once you realize that, it kind of forces you to look beyond the headline numbers and really examine the world that Taeyang is operating in. Because despite having a monopoly, they are facing some pretty serious pressures and hidden risks.
One of the biggest moves they're making is a major strategic pivot. They're actually getting out of China. They sold their big plant in Qingdao, and at the same time, they're pushing much harder into the North American market, focusing on outdoor and leisure activities. It's a huge move to rebalance their global footprint.
But HDIN Research points to 4 big vulnerabilities. First, they don't hedge against currency swings, which is risky. Second, their profits are super sensitive to the price of raw materials. Third, a competitor back home is slowly but surely chipping away at their market share. And fourth, their whole aerosol division is basically sitting idle, running at less than 30% capacity.
This table really sums up the triple threat they're facing. If butane prices go up, their margins get squeezed. If oil prices go up, their transport and energy costs go up. And since they do business in US dollars, if the currency market moves against them, their costs shoot up. They are exposed on multiple fronts. So, after all that, what does it all mean? Let's bring all these pieces together and lay out the final verdict on this quiet giant.
It really is a tale of two companies, isn't it? On one side, you have this incredible fortress, a cash-rich, debt-free global monopoly in a market that isn't going anywhere, super strong. But on the other side, you've got a low-growth company that's not investing in its own future, leaving it wide open to external shocks.
And if you want just one number that reveals their entire mindset, it's this, 45%. Their capital expenditure is less than half their depreciation rate. What that means in simple terms is they aren't even spending enough money to replace their equipment as it wears out. This is a company that is harvesting cash, not investing in growth.
Which brings us to this final, perfect takeaway from HDIN Research. Taeyang is a cash-rich company at a crossroads. So, what's it going to be? Will they just keep harvesting cash from their monopoly and risk a slow, steady decline? Or will they finally use their immense resources to fund a real strategic second act and find new ways to grow? That right there is the billion-dollar question for the invisible King.